I think it's already good that we can keep a good buffer vis-a-vis our plans. I think that I'm particularly pleased that not only on the cost and risk reductions, but also in the client migration, we are doing good progress. We did a migration of clients in Luxembourg early this month and in Hong Kong over the last weekend, and they were successful, which so makes me confident that we can go to the next step with and bring clients together. Yeah.
So this is basically also about IT mergers. Is there anything in that worries you? Or actually?
Well, IT mergers is a big task. We are migrating 110 petabytes of data.
That feels big.
1 petabyte is 500 billions of pages. So it's a pretty complex thing, but we are migrating data. We are not merging systems, and so far so good, but there is no room for complacency, for sure.
What's your biggest worry in the next 12 months?
On the integration front, I think that of course, is a complex task, and therefore things can go wrong. But for me, it's not a matter of if we do it or not, but rather can we do it on time. And then the rest is clearly the macro and geopolitical front is full of open issues that hopefully gets addressed. But if they come all together at one stage, they can create dislocation.
Is that why you're cautious about the fourth quarter? And what does that mean for client activity?
Well, the fourth quarter has, in any case, elements of seasonality. But again, if I look at the macro and geopolitical front, the U.S. election for sure won't be an uneventful topic. So I think that no matter who wins and how they win and how things play out, you're going to see changes and movements in markets. So it will remain to be seen how investors will react to that.
And the U.S. election is exactly 7 days from now. So how do you prepare for that?
Well, we are prepared to basically stay close to clients, advise them, and on how to eventually position themselves and take advantage of any movements. But also, from a bank standpoint of view, of course, we are always prepared for major events. But
so, what do you exactly worry about? Is it market volatility, uncertainty, or is it also the impact, for example, of a Trump presidency on tariffs and on bank regulation?
No, that one is not really the issue. I think that right now the markets are pricing rather a Trump victory, and think that if this is confirmed, it remains to be seen. Is a classical sell on news event, or how he wins will be also determining. Is he in control of the Congress? If Kamala Harris wins, of course, some of the trades that are ongoing for Trump will probably have to be reconsidered, and therefore they're going to create rotations in the market and other movements. So I think, as I mentioned, it's not going to be an uneventful topic.
Does that mean extra inflation, and how do you think it impacts? Is there going to be a standstill of M&A again, depending on what happens and who wins and how they win?
No, inflation, I don't know. Inflation is probably going to be more, a consequence of the ability of central banks to really do the last touch and really bring core inflation below their targets. And the risk there is probably more coming from the geopolitical front. Any dislocation in respect of supply chains, energy access, energy prices can bring back inflation to a level that may slow down the pace of rate cuts. But on the rest, I think that we are well prepared for any scenario.
Sergio, on share buybacks, you have a pretty hefty number that you want to give back. Is there anything that puts that at risk?
Well, it's fairly modest compared to what UBS and other banks are doing nowadays. Is somehow reflecting the fact that we are still midway into the integration. We need to still absorb a lot of cost to restructure and Credit Suisse. So I think that despite the fact that we have very strong results, we still are halfway in the journey to restore the profitability levels that are allowing us to have the similar return on capital we had before the acquisition.
But so again, there are many questions about extra capital requirements also by the Swiss authorities. How does that impact actually your thinking on share buybacks and dividends?
It's a consideration so we always have to think about, but in the short term, this is not going to affect our policy. We are executing our 2024 plans, and we believe that also for 2025, this will not be a major issue, and then of course we have to consider all the elements, but our aim is to continue to our aim is to deliver same levels of capital returns UBS had before the acquisition by the end of 2026.
How are your conversations going with Swiss authorities on these capital requirements, and where do you think they'll land? There's a range between 10 billion and 20 billion.
The conversation are still at technical levels, so I think that it's premature to, the rest is going to be, once we finish technical level discussions, there's going to be then a consultation process. We are not in control of timing, so in that sense, it's way too early to speculate or on this matter. We do believe that we have a very strong capital position, and we do hope for a proportionate outcome.
But is it too early to speculate on a range of the final figure that they'll require?
Way too early.
Way too early. So when do you think that comes? February or later?
I don't know, but it's way too early.
Talk to me a little bit about non-core and legacy. If you say you're halfway there for the integration, have you found any skeletons or things that we should worry about for the future?
No, I think that the vast majority of the risk assessment of this position was done in the second quarter of last year and the early part of the third quarter. That allowed us to then return the guarantee to the governments because remember that the bank had only 72 hours to assess the risk that we were inheriting from the Credit Suisse acquisition. So it was more a matter of liquidating and non-core assets that don't belong to the business model of the future. It's not about de facto taking out toxic assets or things that don't fit the risk profile of the bank. But
you've had a number of high-profile changes of people that run your main businesses. How's that going? Happy with everything?
Yeah, very happy. I think that the results are also quite indicative. Also, the team is working very cohesively, very focused on our task. I think that we are really starting also to not only to focus on helping clients navigate the environment but also the integration, but also we are preparing for the future, and so we are also thinking about how to position UBS for its next chapter.
So what does that look like in Asia, given all of the uncertainty with the China stimulus?
Well, that's definitely an opportunity. I think Asia has been an engine of growth for UBS over the last 20 years or so. We're going to continue to invest and be in Asia. And the stimulus of the Chinese government said that what we saw is probably just the beginning of a longer path of stimulating the economy, particularly the domestic economy. And I think over time is going to play well to our franchise.
What about the U.S.? Your chairman, says you're looking for a wealth manager in a couple of years.
Well, look, right now we are very focused on leveraging what we have in the U.S. Our aim is to narrow the gap in terms of profitability to our peers, and then we take it from there. But of course, we believe that the U.S. and APAC are going to be very important areas of growth. We continue to be very focused also in Europe and particularly in our home market, Switzerland. But so at the end of the day, the value of our franchise is this diversification, both in terms of business and geographic footprint.
But in the US, is there something that you're potentially looking at, or is there a dream trophy asset that you'd like to buy to grow there?
Looks to me that we are quite busy right now in integrating one big one. So, I mean, one by one.
Talk to me about consolidation in Europe. You've spoken before about the need for consolidation. Yeah. There's now a potential merger, but there are a lot of question marks on whether it can go ahead.
Look, I don't want to really comment on specific transactions, but I can only reiterate that my view is that consolidation it's necessary in Europe for banks. I think that it's very difficult for banks to sustain the economy, to sustain all the investment needed to go through the reforms necessary for Europe to flourish again. We don't have a capital market union, so we need at least a banking union that makes banks stronger. So for me, it's inevitable, and so banking union and capital market unions are only part of the puzzle that will allow probably Europe to, win back some momentum.
But is this a litmus test? If we have, cross-border consolidation in the next 6 to 12 months, is it a good sign for Europe that it's open for business?
Yeah, I mean, look, first of all, we have to look at what makes sense or not. So we should not force any merger just for the sake of demonstrating anything. So first of all, the private sector has to make a decision what is economically, strategically viable and economically viable. Right. The feasibility part of the equation, i.e. the willingness of politicians and regulators to allow mergers, was always a big issue. Now, we should not have a situation in which that third element is the impediment. Right. Now, of course, all countries needs to be very focused on creating the right prerequisite for these transactions to go through. And if they fail because of national interest, one way or the other, that would be a very bad chapter for Europe.